Hello, class. Good morning. My name is Chebet, and I'll be taking you through accounting theory. I hope you all can see my screen. So yeah, defining the term theory. A theory is a well-substantiated explanation or framework that describes, predicts, um, and explains a phenomenon or set of phenomenon. It is based on empirical evidence, observations, and logical reasoning. So it's not something that you can just come up with. The purpose of a theory is to provide systematic and coherent understanding of a particular subject or area of study, allowing for predictions and further explanations of the topic. The development of a theory involves formulating hypotheses, conducting research, and experimenting analyzing data, and refining or revising the initial explanations based on new evidence. Theories are used in various disciplines. For example, natural sciences, social sciences, and humanities to provide a conceptual framing for understanding, making sense of observation, and guiding further investigation. So we'll have to also define the term accounting, and accounting is the process of identifying, measuring, communicating financial information to stakeholders such as investors. Investors are people who put in money for certain projects, creditors, regulators, defining accounting as a systematic and structured discipline that involves collection, analysis, and reporting of financial data to support decision-making, ensure accountability, facilitate economic transactions, and so much more. According to Johnson, accounting may be defined as collection, compilation, and a systematic recording of business transaction in terms of money, preparation of financial reports, interpretation of the reports, and using these reports for guidance of management. And according to the American Institute of Certified Accountants, accounting is art of recording, classifying, and summarizing in a significant manner in terms of money transactions and events, which are in part, at least, of a financial character, interpreting the results thereof. While we're defining the term, we also need to understand the term accounting theory. This is a cluster of accounting frameworks and historical practices that are used, that are based on the applicable accounting frameworks, such as generally accepted accounting principles or international financial reporting standards. And these frameworks are based on a lengthy process of formulation and review by the top experts in the field, and so are designed to address the bulk of the accounting situations that are the typical accountant is likely to encounter, okay? So it's also historical precedent is typically used, and especially good use for accounting theory in dealing with entire new areas of accounting, which requires new rules. The nature of accounting theory. So the nature of accounting theory refers to the characteristics and principles in development and application of these accounting theories. And the first one is descriptive and prescriptive nature. Accounting theory can be either prescriptive or descriptive. Descriptive aims to explain and describe existing accounting practices and principles, while prescriptive, on the other hand, provides guidance on recommendation for how accounting should be practiced, okay? Or how financial reporting standards should be developed. The second one is normative and positive approach. Accounting approach can be approached from both normative and positive perspectives, as we've said. The normative focuses on establishing normative principles, while the positive approach seeks to understand and explain accounting practices as they are. The third one is conceptual framework development. This provides a foundation for financial reporting standards. The framework establishes fundamental concepts, principles, and objectives that guide the measurement, presentation, and disclosure of financial information. Good. We have development through research, which is still part of the nature of accounting theory. It involves empirical studies and analysis of data. We have subjective and judgment. This acknowledges the inherent subjectivity and judgment involved in accounting practices. The selection of accounting methods that you use as a person or as an accountant, the estimation of values, interpretation of financial information requires professional judgment. We have influence and external factors. These are influenced by various factors such as legal, regulatory, social, economic considerations. And this basically means when there's change in laws and regulation, then it affects how accounting is practiced. Adaptability and relevance. Accounting theory needs to be adaptable and relevant in that it should be flexible enough to incorporate new developments and respond to evolving requirements of financial reporting and decision making. I hope we are together. So we have components of accounting theories. Yeah, this is something that most of us are familiar with. So the first one is objectives. These are basically the targets that have been put in place to achieve all these assumptions. Is the second one, which is an entity of assumption. It's treating the business as a separate entity from its owners. The going concern assumption, which is assuming that the business will continue its operation even after the owner is gone. Continuity, in other words. The third one is principles. It includes accrual basis of accounting, where you can record revenues and expenses when they're earned or incurred, regardless of cash flows. Like the accounting principle, like they remain to be used. Yeah. The fourth one is concepts. This provides guidance such as materiality, substance over form, consistency, and conservatism, which helps to ensure relevance, reliability, and comparability of financial information. Components of accounting theories. We're going to be looking about the components, which means what the accounting theories has in it. The first one is the standards and regulations. These are the set rules issued by standard setting bodies. Yeah, and you can mention some of them, which include International Financial Reporting Standards, IFRS, and generally accepted accounting principles. The second one is reporting framework. This includes, it defines the structure and content of financial statements, how you should report. For example, how a balance sheet should look like, how an income statement should look like, and so much more. The third one is research and empirical evidence. It is informed by ongoing research and empirical evidence. Researchers investigate accounting practices, they analyze financial data, and they also conduct studies, which are basically research, okay? The fourth one is stakeholder needs. Which means accounting take into consideration the needs and interests of various stakeholders, such as investors, creditors, regulators, management, and so much more. Stakeholders are literally anyone who is part of a given company or organization. We have the factors necessitating of accounting theories. The first one is changing business environment, wherein we have a nature that's quite dynamic. It keeps changing, and so there's need to adapt and evolve these business practices and transactions. The second one is user information needs. For example, investors, creditors, and regulators, they have diverse information needs. Each has the kind of information that they'd like to know. So it's supposed to be tailored to meet their needs. The third one is complexity of transactions. With increase in complexity of business transactions, there's need to develop standards and guidelines to ensure so that it's quite uniform. You don't go to another place and then you find how they're doing accounting is different. That's why we have bodies that come up with these guidelines. Yeah. The fourth one is legal and regulatory requirements, which provides a foundation for the development of accounting standards and principles that have to be complied, yeah, and has legal obligations. We also have economic decision making. This is basically used to evaluate financial performance of a given company or organization and be able to know the prospects of an entity, okay? It aids in decision making of the company. We also have stakeholder confidence and accountability. This is very crucial. And by providing guidance on accurate measurement, proper recognition, and appropriate disclosure of financial information, accounting theory ensures transparency, accountability, and prevention of fraud. International harmonization. As a business becomes increasingly globalized, there's need for harmonized accounting practices. We also have ethical considerations is the last one. This is basically ethical behavior, integrity, and professional responsibility, ensuring that accountants and financial professionals adhere to ethical standards. We also have accounting principles, matching principle, as you all can see, consistency principle. Yes, someone can help us read another one. Yeah, going concern principle. Next, we have conservative principle, we have accrual principle, and also full disclosure principle. So we're going to be looking at each of them one by one. Okay, we're almost coming to the end of our lesson. So yeah, the first one is business entity principle. There must be a separation between investor and the business itself. It means the transaction should be recorded from the point of a business, not from the point of a view of a businessman, okay? There's money measurement principles. This assumes that only transactions recorded in the books of accounting, of accounts are supposed to measure the monetary value, okay? We also have going concern concept. It means the business should be continuous to exist for a long period of time. Its life is uncertain. You cannot give a business a lifetime to expire. It has to be continuous. That's the going concern concept. We have also accounting period principle. The entire life of the business is divided in the period time, generally 1 year. Yeah, that's why there's usually reviewing of accounting information and all that. Cost principles, all the businesses transactions recorded at the cost price. We also have matching principle, which means the cost or expenses of a particular period matched or compared with the revenue of that period for the determination of profit and or loss suffered, okay? We have realization principle, which is also known as revenue recognition principle. Revenue is considered when goods are sold or services are rendered, where the transaction is made on credits or cash. We also have dual aspect concepts, which means that every transaction has twofold effect. For example, the debit and the credit side, when expenses increase, they're supposed to be on the debit side. When they reduce credit side, we have initially looked at all those concepts, and this is just a basic of what we've just talked about. So please look at it, these accounting concepts. Look at every one of them as we've just looked at them, revised them. And then here is your assignment. Please discuss the role of accounting and accounting regulatory bodies in Kenya as groups, and make sure that you submit. I have handed my email to the class representative. Please submit by next week, Friday, when we meet next. Thank you. And unless anyone has a question, we're going to end our class there. Thank you.